Hello, Assalamu alaikum. How are you all? Welcome to the second session of this Practice to Pass webinar conducted by ACCA. I hope all of you would be doing well and all of you would be safe. Today, the day 2 of our webinar, today's agenda is, if I were to highlight, the today's agenda is inheritance tax and value added tax. As you guys would be aware that the taxation is one of the lengthiest syllabus of all of the fundamental papers. So we have to cover it in a smarter way that we can cover all of the areas, we can do as much practice as we can. So that's why I'm keeping a hard target for today. I know like inheritance tax and VAT are two broad areas, but we'll try to cover it. So the idea is first we would be covering the inheritance tax. Then in the second row, you would be covering the value added tax. So for the first instance, first we cover the inheritance tax, then we'll do the questions, then we'll come to the value added tax, then we'll do the question. This would be my approach for today's session. Let's start without further investing our time in anything. Let's start the today's agenda, and these are the questions to be done today, the to-do list task of today. By the way, students, I don't know whether you noticed or not, yesterday I was not able to do one question, that was Ginger, Innocent and Nigel. That was the question 3 of the MTQ number 3. So I would appreciate if you guys solve it at your own. Give me a time of day or two. I will share the video solution of this. I will share the video solution. So try to solve it at your own. Okay. Then for today, if anything, any question left over, please, I would appreciate if you guys like do some effort at your own side, and so that we would be able to utilize these 3 hours more efficiently and effectively. To in lieu of this, I need your cooperation, and eventually you have to do the paper, so you would cooperate. I trust this. Well, let's just start. All of the stuff is available on Dropbox in a shared drive. So I prefer to share the stuff on the Dropbox. However, if anything which is other than the class material, would for sure share in this group, in this WhatsApp group. But my first preference to share the stuff over the shared folder, that is the Dropbox, so that if anyone is joining late or early in the WhatsApp group, so everyone can access that stuff. Okay, let's start the revision session for today class. Let me zoom out this. Okay, this is the day 2 of this revision session. We are going to start the inheritance tax basics. Inheritance tax, like I marked yesterday, on the most minimum side, make it is for 10 marks, and it on the maximum side it can go up to 15 marks. Same thing goes for the capital gains, same thing goes for the inheritance, and the same thing goes for the value added tax, that is the upcoming topic for today. So without again, let's start the discussion of inheritance tax. Inheritance tax essentials. What are the essentials of inheritance tax? There should be transfer of value. There should be transfer of value. Transfer of value means there should be a capital gift, there should be loss to estate, there should be diminution in estate. If there is diminution in an estate, there would be ISD. Chargeable property. Chargeable property means, like we discussed for capital gains, the term chargeable assets. In the same way, we are going to discuss the word chargeable property. Chargeable property is all except of overseas assets owned by non-domiciled individuals. So anyone who owns the asset out of UK and is not UK domiciled is out of the scope of IHT. Otherwise, all of the persons are in the scope of IHT. Make it in this way, making life sweet and simple. All UK persons have to pay the UK IHT. Chargeable person, individual who is domiciled or deemed domiciled in the UK. The domiciled is like a one step ahead from the resident. So we have to study the residency concept. It's part of our TX syllabus, an important part. But the domicile, just you need to be familiarized with this word domicile. Domicile word means any person which is like my permanent place of residence. So for 1 year, if I'm resident, that's a different thing. But if I'm residing in UK for make it, if I'm residing in UK for make it 5 years, 10 years, or if I plan to live permanently in the UK, so I would be considered as a UK domicile. Keep remember one thing, the concept of resident and domicile is only applicable for tax purposes. It has nothing to do with the British passport, with the nationality, with the citizenship. All of these concepts are different things. All of these things have nothing to do with the domicile concept, residency concept as well. Okay. Occasion of charge. When the IHT is applicable. IHT is applicable at the time of death, gifts within 7 years pre-death, and it is applicable on other lifetime gifts, for example, CLTs. So IHT is applicable on death, that is estate. It is applicable on gifts within 7 years pre-death, that is PETs, CLTs within 7 years of death, and other lifetime gifts like CLT at the time of transfer. Lifetime gifts. Lifetime gifts can be categorized into two categories. Either it can be PET or it can be CLT. What is PET? PET is, but like not asking the abbreviation, it is potentially exempt transfer. PET is gift by an individual to another individual. So for your purposes, this thing is irrelevant since it is not examinable. So I'm cut-offing it, but gift to individuals by another individual is PET, and CLT is any gift which is not exempt or a PET. For example, transfer to any trust is referred as the CLT. Chargeable asset. What are the chargeable assets? Chargeable assets are, sorry, chargeable. PET is only chargeable if donor dies within 7 years of gift. Keep remember, PET at time of transfer is exempt from tax. It is only chargeable if donor, if transferor expires within 7 years of death. CLT is chargeable at the time of death, like when the gift is made. Additional IHT if donor dies within 7 years of gift. So if donor dies within 7 years of gift, then this CLT becomes taxable. Tax rate. The tax rates are death rate 40%, death rate 40%, lifetime rate if paid by donee 20%, donor if paid by donor 25%. That is gross gift for tax paid by donor. And who is supposed to pay the tax? The tax is paid by donee, like transferee. For CLTs, again donee. For lifetime tax of the CLT, it can be paid either by donee or it can be paid either by the trust. So, sorry, it can be paid by donor, it can be paid by donee, it can be paid by person, it can be paid by anyone. So that's the very basic introduction. Any question till now? PET stands for uh, potentially exempt transfer, and CLT stands for chargeable lifetime transfer. It would be mentioned that who is going to pay the tax. Either it would be the donee or donor. Like I have never seen any of the exam question which is unclear about this at this TX level and at this ATX level. So there is no silent presumption about it. However, like from the exam kit perspective, there are possibilities that in certain situations of exam kit, not an exam question, exam kit. So in certain situations in exam kit where it is not mentioned, then exam kit presumes that the tax is paid by the donee, the trust. No one said that PET is not taxable. Like PET, the second example which was mentioned here, that is out of the scope. PET itself is examinable. It is PET is examinable. It is part of your syllabus, please. And any question further? So moving ahead. The concept of taper relief. The concept of taper relief is applicable on gifts. Gifts means it is applicable on PET and CLT. Gifts in 3 to 7 years pre-death. Pre-death, like if there is a time gap of more than 3 years, but less than 7 years between the PET CLT date and the death date, then there is a concept of taper relief. So you have to look the time gap between gift date and death date to decide the taper relief thing. The time gap, if the time gap is 3 to 4 years, then relief is 20%. If the time gap is 4 to 5 years, taper relief 40%. 5 to 6 years, 60%. 6 to 7 years, 80%. Keep remember, this taper relief is applied on the this is percentage of IHT payable. So whatever is your IHT liability, you would be applying this taper relief percentage over that IHT liability amount. Keep this thing clear, keep this thing in your mind. Okay. By the way, taper relief is a commonly asked feature of the ATX. Of this TX session. Any lifetime tax paid on CLT falling within 7 years pre-death can be credited against death tax but cannot lead repayment. Like you have paid the lifetime tax of CLT. This statement implies hold on. Yes, so I have this thing. So for the explanation of this, I'm moving to the next page. I'll be coming back here. For explanation of this, summary of computation at death tax at death time, if gift become taxable. So if gift is taxable, so what is the summary of computation which you are supposed to make? It is tax on taxable amount at 40%. So whatever is the taxable amount, apply the tax rate of 40%. This 40% is the death rate. Less taper relief percentage. So taper relief percentage would be decided by the time gap between the death date and the gift date and the death rate. This amount would be multiplied by this percentage, whatever is the taper relief percentage, then you get the taper relief, then percentage chargeable after taper relief or amount chargeable after taper relief, less lifetime tax paid. So lifetime tax paid is only for the CLTs, because in life, CLT is taxable. In life, PET is exempt from tax. So here the lifetime tax paid by CLTs can only be for the CLTs. It cannot be for the PETs. Then IHT due. If IHT receivable, then restrict the lifetime tax paid amount. Okay, so if IHT, sorry, so if IHT receivable, then restrict the lifetime tax amount. So after the taper relief discussion, summary of exemptions and relief. So what are the reliefs exemptions available in IHT? There are certain reliefs exemptions which are available in lifetime gifts only, and there are certain reliefs or exemptions which are available at time of death estate only. Reliefs exemptions available to lifetime gift and death estate only. So what are the reliefs exemptions available in lifetime only? First is called as annual exemption. The annual exemption is 3,000 per tax year. We carry forward annual exemption for maximum 1 year if not utilized. While using the annual exemption, use your current year first, then use the brought forward annual exemption. So while using the annual exemption, use current year first, then brought forward. Small gifts are exempt from IHT. What is the definition of a small gift? Any gift which is less than 250 pound total gift per donee per tax year. 250 pound total gift per donee. Like I can give up to 250 pound of gift or gifts to one person in one tax year. If exceed from 250, then whole amount is chargeable. It would not be exempt. So make it in this way. If I transferred assets worth 100 pound and 200 pound to my brother, both would be taxable. Both would be taxable. The complete 300 would be taxable in 1 year. However, if I transfer asset worth 100 pound to my brother and 200 pound to my sister, 100 pound to my brother and 200 pound to my sister, then both would be exempt because less than 250 pound per year per donee. Marriage exemption. Marriage exemption is if the person gives some gift over the marriage, then there is the concept of marriage exemption. If the gift is by parent, like if the gift is given to children, then the marriage exemption is 5,000 per parent. Like mother would have her own marriage exemption of 5,000 and father would have his own exemption of 5,000. 2,500 per grandparent. Like if the grandparents are giving you gift, then the exemption is 2,500, and 1,000 for other persons. Other person means your siblings, your friends, your uncles, aunts, your ex-friends, which would no longer be a friend after the wedding. So all of such persons, 1,000 is the exemption limit. Normal distribution out of income. So IHT is not applicable on normal distribution out of income. What is normal distribution out of income? Normal distribution out of income is anything which is like if I earned something and I spent the amount, so uh, it is from my if I'm habitual to make such transfers, if it does not impact my standard of living, then such things are called as normal distribution out of income. And if the distribution is normal distribution out of income, then IXT is not applicable. Lifetime gift and death estate, inter-spouse civil partners are exempt. So the good thing is transfer between spouses are exempt from IXT purposes in life or in death, whenever, whatever. From capital gains perspective, the transfer between spouses is at no gain, no loss. Keep remember, for capital gains purposes, it is not exempt. It is taxable, but no gain, no loss. Here it is exempt. So I'm looking for the questions. So and okay, I'm going to repeat that district thing. For lifetime IHT, some gift or others also. Explain this point again. So we discussed by default donor. For lifetime IHT, same gift or others also. It is for lifetime gift, which I was talking about. It is for the same gift, not the other. Then uh, the restriction. There is some tax. There is some tax on taxable amount, which is at the rate 40%, less taper relief, which would be depends upon the time gap between death and the death date of gift and the death time. Percentage chargeable after taper relief or amount chargeable. Less lifetime tax paid. It is only for CLTs, not for PETs. Then I get the IHT due. Okay. Is it possible that this amount would be greater than this amount? Yes, it is possible. Like it could be possible that relief percentage is so high so that I get this amount in negative after deducting this lifetime tax paid. So if in place of IHT due, you are getting IHT receivable, then you have to restrict the lifetime tax paid amount. So you are not going to restrict the taper relief thing. Rather, you are going to restrict the lifetime tax paid amount. Now, how to calculate the value of gift? This is an important thing. How to calculate the value of gift? The value of gift is calculated by the concept which is called as diminution principle. Diminution principle means your reduction in wealth. Like what is the reduction in wealth due to the gift? So to calculate this value, the calculation would be value of estate before gift, value of estate after gift, whatever is the differential is the transfer of value. So transfer of value is to be calculated as by taking the difference of value of estate before gift minus value of estate after gift. No, okay. This generally follows the principle of 1 plus 1 is equal to 2. Make it, if my value of estate is before gift 2 million, maybe value of gift after estate is 1 million. So my transfer of value is simply 1 million. This value is do not follow 1 plus 1 is equal to 2 approach, does not follow this approach. Whenever there is a part disposal, whenever there is a part disposal, and whenever there is a shares transfer, especially of quoted company, especially of quoted company. One thing. Second thing, keep remember here value of estate before gift and value of estate after gift would be using the related person valuation rules. It should be by using the related person valuation rules. So I would be covering the related person valuation rules shortly. Then after this, any of the specific exemption, if it applies, a specific exemption as in spouse exemption for at your level, only spouse exemption, then marriage exemption, then annual exemption first this year, then last year, then revised transfer value which is subject to IST. Keep remember, if this value is of PET, it would be exempt. If this value is of CLT, then we'll calculate the tax over it. And how to calculate the tax over it to be discussed immediately. The next concept is over the residential nil rate band, and important concept to discuss, the residential nil rate band. The concept of residential nil rate band arises where main residence is inherited on death to direct descendants. Direct descendants are children and or grandchildren. So direct descendants are children or grandchildren. Both are the direct descendants. If residential, okay, the residential nil rate band is not applicable on CLTs, PETs becoming taxable due to death within 7 years. So it is only applicable on transfer of main residence to direct descendants on death. There are basically three conditions. First, it should be main residence. Main residence means the residence in which person lives. Inherited on death means it should be transferred on death. So not transfer on life, it should be transferred on death. To direct descendants, to whom the asset should be transferred, it should be transferred to the direct descendant. Direct descendants are essentially the children and the grandchildren. The residential nil rate band is not applicable on CLTs or PETs becoming taxable due to death within 7 years. So if you transfer the main residence in life and it becomes taxable within 7 years, residential nil rate band is not applicable. Any property which is let out or used for investment purpose does not qualify for residential nil rate band. The value of property is after deducting any mortgage payable secured on the property. If value of property after deducting mortgage payable is less than 150,000, which is the residential nil rate band limit, the value of residential nil rate band also reduced to the value of residential nil rate band. Like transfer of nil rate band between spouses, the same way of residential nil rate band also transfer between spouses. So the normal nil rate band can be transferred, like residential nil rate band also transfer between spouses. It is an important thing. Keep one thing remember. Residential nil rate band, like mentioned 1, 2, 3 points. Specifically this one. Residential nil rate band is not applicable on property which is let out or used for investment purpose. So if you purchase the property not living by yourself, you have rented out the property. It is a house, you have rented out the house to another person. So would you get the residential nil rate band? No. But from capital gains perspective, would it qualify for the 18 or 28% or 10 or 20%? Keep remember, for capital gains purposes, there was never ever discussion about whether you live in the property or not. The question was only one. Is the property residential or non-residential? If residential, rate of tax 18, 28. If not residential, rate of tax 10 or 20. But here in the IHT, residential, it should be residential. Not only residential, the second condition is it should be your main residence. The main residence means the property in which the person lives. So I would be sharing with you guys the WhatsApp number to join, but at the time of break somewhat. Okay. Then the important discussion again, like every discussion is important here. Payment of IHT. The payment of IHT. If the CLT is made between 6th April to 30th September, the due date is following 30th April. If the CLT date is from 1st October to 5th April, then 6 months after the end of the month of transfer. Keep remember, these two things which we are discussing is for the lifetime tax, whereas these three things are for the death tax. PETs, which are chargeable as a result of death, 6 months after the end of month of death. So assumingly, if I take it today's date, assumingly today's 23rd August, and if on 23rd August the person expire, there is a PET which is becoming taxable. What will be the due date to pay the tax? The due date to pay the tax would be 6 months from the month end of that. So the month end it would be 31st August. And if I count 6 months from 31st August, that would be 28 Feb 2021. So that would be the timeline due date to pay the tax. Additional tax due on CLTs within 7 years pre-death, 6 months after the end of the month of death. State at death, 6 months after the end of month of death. Okay. Some of the things which I can, like, which are not here, which should be. First, state calculation. All assets should be included in state at probate value. I hope you guys would be familiar with this terminology. Probate value is the market value at the time of death. All assets should be included in state at probate value except of insurance policy where proceeds amount Hello, welcome back, students. Can you hear me now? Can you see my screen? You guys can see the screen. Appreciate if any one of you can drop this message at the WhatsApp group as well, because I can see some of the one who was like informing that please update once it's resume. Thank you. Okay, so we were discussing the state. Okay, for state purposes, first thing, all assets should be included in state at probate value, except of insurance policy where proceeds amount would be taken rather than market value. So for all of the assets, you people are supposed to take the market value of all of the assets at the time of death, except of insurance policy where proceeds amount would be taken rather than market value. So all assets. Then for estate calculation, the second thing, by the way, estate is defined as total assets minus certain liabilities or expenses. I defined the assets. Now I'm going to define certain liabilities or expenses. What are the liabilities or expenses? Certain liabilities or expenses means some liabilities or expenses are allowed and some are not allowed. Allowed liabilities or expenses are mortgage loan allowed, credit card bills, outstanding taxes, funeral expenses, any other loan payable. Not allowed category are first, endowment mortgage not allowed, verbal promise, without consideration not allowed, gambling debts not allowed, and the last thing, executor or personal representative expenses are not allowed. Who is executor or personal representative? It is the person whose main job is to settle the is to pay off the IHT liabilities to HMRC and make sure that asset is distributed according to the will of deceased person. Uh, what is endowment mortgage? Endowment mortgage is any of the mortgage which is insured. So in case of that, the person is not supposed to pay the remaining mortgage, rather it would become the responsibility of insurance company. Such mortgage is called as endowment mortgage. Then after the discussion of estate, the second discussion, advantages, like these are the important theory points. Advantages of lifetime transfer. What are the advantages if you transfer the asset in life versus a transfer on death? First advantage, lifetime transfer is a gamble, as in if survive for 7 years, exempt. If survive for 3 years above, you get the taper relief. First advantage. Second advantage, there are too many exemptions. Reliefs available. Like annual exemption, marriage exemption, a small gift. Whereas for estate purpose, there is no separate exemption. Third, and the most powerful advantage, value of transfer, not value of transfer, value of asset freezes at the time of transfer. Thus, increase in tax due to increase in asset value is safe if decline in asset value, we get fall in value range, which is not in TX. Like this relief is not in TX. This relief is not in TX, but just to share the name with you, like if there is a increase in asset value, your tax would be saved. If decrease in asset value, you will get relief, but the relief calculation discussion is not in the scope of TX. Then the last theory before I move on to the questions. IHT planning points. IHT planning points. First point. Transfer the estate. Transfer the residential property to direct descendants. To get the residential nil rate band. Second, transfer the estate to a spouse to get exemption and free up your NRB and RNRB. Which can be transferred to a spouse at transfer the estate to a spouse to get exemption and free up NRB and RNRB. Third way out, transfer more assets in life due to above mentioned advantages. Fourth is called as skipping the generation. Skipping the generation, keep remember, it does not save immediate tax, rather it saves potential future tax. Skipping the generation. Skipping the generation, it does not save your immediate tax, rather it saves your potential future tax. What is skipping the generation? Just I like to few comments over fourth advantage. Skipping the generation means if there is a grandfather, there is a father and son. So from an asset transfer from grandfather to father and then from father to son, where once asset is transferred from grandfather to father, there will be IHT. From father to son, there will be IHT. So one thing is called as skipping the generation, which is like transfer the asset from grandfather to the son. Skip the generation of father. What's the advantage of skipping the father? The advantage is like the future possible tax would be saved. Like whenever the father will die, he has to pay the tax, then asset will be transferred to the son. This one tax will be saved. Keep remember, from a grandfather perspective, whether the assets are transferred to father or to son, it makes no difference. Like at the time of death, grandfather owned the asset. If the asset is taken by daughter or by son, grandson, granddaughter. it makes no difference. All of are same with respect to today's IHT calculation. What makes difference? The difference is for future possible tax, like from grandfather to father, from father to son. One tax from grandfather to father, second tax from father to son. Skipping the generation saves the possible tax which is to be paid on the death of father. So no change on today's tax. How we can achieve these all of the stuffs? Majority of the stuffs. One thing is called as altering the date of variation. How we can achieve these advantages, like how we can skip the generation, how we can transfer the residential property to direct descendant. These things can be achieved by altering the deed of variation, like change the will of person. Can we change the will of a deceased person? Yes, two possibilities. First, by order of court of law, like court of law orders us to change the will. Second, if all beneficiaries to estate agree to change the will. And what is the time limit? It should be within 2 years of the death. That could be a possibility that HMRC would not be agree to change the will, but we agree and we want to change the will. Any questions so far? Tax is always calculated on original value. So whatever at the time of transfer, whatever is the value of asset, it frees for the purpose of IHT. So like I said here, value of asset frees at the time of transfer. So whenever you make a transfer, whatever is the value of asset, it frees, it fixed for the purpose of your tax calculation. So it would not gonna change. Okay, let's start the MCQs, like 2-3 MCQs for the IHT, then we'll move on to the CRQ. A. Wong died on 4th January 2020. When his wife died on 3rd August 2008, only 30% of her nil rate band of 312,000 for the tax year 8-9 was used. How much nil rate band is available against Wong estate? How much nil rate band would be available? Keep remember, the nil rate band would be Wong own plus spouse unused. Wong own nil rate band is 325,000 plus spouse unused nil rate band would be 325,000 multiplied by 70%, not 3112. Only 30% was used. So unused would be 70%. So that would be 325,000 into 70%, because keep remember a principle for IHT. in which year you are calculating the tax rate and allowances would be applied for that year. So if you are claiming the unused nil rate band in this year, the tax rate and allowances of this year would apply. So accordingly, my answer would be double five 555 to 500. Uh, for the best way of best way to remember dates, I will be sharing a separate handout with you guys over the WhatsApp, plus would copy in your Dropbox. And I would request you guys, all of you, to read that dates very carefully. And uh, it's like a prescription from my side to remember the dates. Take one dose in the morning after wake up, and one dose in the night before sleep. And if it does not work, then increase the dose. Like take this dose 3 or 4 times, but you have to. So no other option to apart from that dose. So would share with you guys either by today night after this. Second, on 22nd May 2018, Winston made a gift of 4,400 to his son. On 7th September 2019, he made a gift of 7,200 to his daughter. What is the value of PET made on 7th September 2019 by Winston to his daughter? Okay. That would be 7,200 for fiscal year 1920 PET. Annual exemption for fiscal year 1920. 1819 annual exemption would be available? No, because in 1819 he has already made a lifetime transfer, so not annual exemption available. So the net tax value would be for IHT purpose. That would be 4,200. Last MCQ. On 20th November 19, Alex made a gift to our trust, and this resulted in a lifetime IHT liability of 46,000. What is the due date for IHT liability of 46,000? For the and it is a lifetime tax, not a death tax. For a lifetime tax, what is the due date? The due date is, so I have to check, like if I open up the notes, thank God that I able to recover my notes, written stuff. So if CLT is between 6th April to 30th September, and if it is from 1st April to 5th April, if I look into this date, 20th November 19, it falls in the category of 1st October to 5th April. If it is from 1st October to 5th April, what will be the due date? 6 months after the month end of transfer. So month end of transfer 30th November. 6 months from 30th November is done. I would share the number and the link, WhatsApp link of this session at the end of this webinar. So would share that at the end. Then moving ahead, let's look into the question. You, you should assume that today's date is 1st March 2020. Lebna and Lulu were a married couple, but unfortunately Lulu died on 24th January 2016. Lulu left an estate valued at 210,000 for the IHT purposes. The estate did not include a main residence. Under the terms of her will, Lulu left a specific legacy of 40,000 to her brother, with the residue of her estate to her husband, Lebna. Lulu had made the following lifetime transfers. 13 Feb 2008, chargeable lifetime transfer 50,000. 21st June 2014, potentially exempt transfer by the amount 80,000. Both of these transfers are after taking account of available exemptions. The nil rate band for the tax year 15-16 is 325,000. Lebna chargeable estate. Lebna has a chargeable estate valued at 980,000. His estate include a main residence valued at 340,000, on which there is an outstanding interest only mortgage of 152,000. Fine. Under the terms of his will, Lebna has left his entire estate to his son. So Lebna has made entire estate to his son. Fine. Gift to son on 22nd Feb 2015. On 22nd Feb 2015, Lebna made a gift of £60,000 ordinary shares in Green Limited, an unquoted investment company, to his son. Before that transfer, Lebna owned all of the Green Limited share capital of 100,000 ordinary shares. The market value of Green Limited ordinary shares on 22nd Feb 2015 was as follows: holding 40%, market value 4.2, 60% 6.3, 100% 7.1. Lebna has not made any previous lifetime gifts. Gifts to friends during October 2019. Lebna has made cash gift of 85, 225 and 190 and 490 to various friends during October 2019. The gifts of 85 and 190 are to a same friend. Fine. Questions. If Lebna were to die today, make it 1st March 2020, how much of Lulu nil rate band will the personal representative of Lebna state to be able to claim when calculating the IHT payable on chargeable estate? So first I have to look for the state of Lulu, then can comment about it. Lulu nil rate band is 325,000. Then legacy to brother by the amount 40,000. Then a PET, which is within 7 years of death, hence taxable. And the PET amount, what was the PET amount? The PET amount 80,000. If I look into this date, 13th Feb 2008, is it within 7 years or more than 7 years old? This is more than 7 years old. Hence, it would not be taxed at the time of death. So this amount 325 minus 80 minus 40, this amount. So if Lebna were to die today on 1st March 20, how much Lulu nil rate band will be able to claim? The answer is 205,000. Uh, 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 please, can you guys be like bit quick in the calculations? Like, I'm getting bit slow response in the calculations. Then, if Lebna were to die today, 1st March 2020, what is the total amount of residence nil rate band which will be available when calculating the IHT payable on his chargeable estate? What is the total, if Lebna were to die today, 1st March, what is the total amount of residence nil rate band which will be available. So what will be the total amount of residence nil rate band? The nil rate band is, okay, remember, like normal nil rate band, residential nil rate band also transfer between spouses. Lebna nil rate band plus Lulu unused nil rate band, sorry, residential nil rate band. Lebna own residential nil rate band plus Lulu unused. What is the like? Does Lulu use the residential nil rate band? The answer is no. Lulu has only one specific asset which she transferred to her brother and nothing else. So all of her residential nil rate band would be unused. So the total residential nil rate band available is 300,000. Whereas if I look into the value of estate, sorry, value of residential property. If I look into the value of residential property, what was the value of residential property? Residential property valued at 340 and there is a mortgage of 152. So 340 minus 152. So what is the value of property for IHT purposes? That would be 188,000. So what will be the value of residential nil rate band which would be available? So remember the residential nil rate band point. If net value of residential property is less than the residential nil rate band, then residential nil rate band would reduce accordingly. So for my IHT purposes, the residential nil rate band would be the lower of these two things, you can say. So if my value of property is more than 300, then it would be 300. If the value of residential property is less than 300, then my residential nil rate band would be less than 300. And in this case, it is less than 300. Yes, it would be wasted. No, we are not supposed to calculate the proper IHT. We are supposed to calculate only residential nil rate band. For shares, residential nil rate band is not available. It is not applicable. I hope it clarifies. What value, what is the amount of potentially exempt transfer which Lebna has made to his son on 22nd Feb 15, the gift of 60,000 shares in Lean Limited after deducting any available exemptions? Okay. Before transfer, before transfer, on 22nd Feb 15, 100,000 ordinary shares. He has, before transfer, Lebna own all of the share capital of 100,000 ordinary shares. So 100,000 ordinary shares means before transfer, he has 100,000 ordinary shares. The value per share is 7.10. So that translates into 710,000. After transfer, that is, he transferred 40,000 shares. No, he transferred 60,000 shares. So after transfer, how many shares would be there? 40,000. 40,000 shares means 40%. 40% means that would be 4.2. 40,000 multiplied by 4.2. That turns out to be the transfer of value amount. Can you hear now, Williams? Are we eligible to use no more? Okay, this amount 542, and the requirement asked after deducting any available exemption. So did we deduct any available exemption by now? The answer is no. So 542 less annual exemption of fiscal year 14-15, annual exemption of 13-14, like brought forward annual exemption. The answer is, so the correct answer is 536. Then, if Lebner were to die today, 1st March 2020, what taper relief percentage reduction fees would be available when calculating the IHT payable on PET, which he made to his son on 22nd Feb 15? And when would this IHT be due? So let's first talk about when this IHT will be due. It is 1st March 20, 6 months from month end of that. Month end of that would be 31st March 20 and 6 months. So 30th September would be the date. So 30th September 20 would be date. So either option A or D are correct. Okay. Second question. What taper relief percentage reduction would be available? What taper relief percentage reduction would be available? Now, the PET date was 22nd Feb 15. Count with me. From 22nd Feb 15 to Feb 16. 1 year, 2 years, 3 years, 4 years, 5 years, 6 years. So the debt is after this date, but before this date. So it is 5 to 6 years. And for 5 to 6 years, the taper relief percentage is, the correct answer is option A, not the option D. Yes, for annual exemption, first take current year, then take the brought forward. It is always. Second, the due date is, I repeat, at the time of death for estate. Focus on my wording. At time of estate, at time of death, whether IHT is on estate, whether IHT is on CLT, whether IHT is on PET. The due date is 6 months from month end of death. In this situation, the Lebner dies on 1st March 2020. Month end of death would be 31st March 2020. Count 6 months from month end of death. So 6 months would be 30th September. From 31st March, count 6 months, that would be 30th September. I hope it clarifies. What amount of cash gifts by Lebner to his friend during October 19 is covered by the small gift exemption? Small gift, less than £250 per year per person. So, gift of 85, 225, 190 and 490 to various friends during October 19. The gift of 85 and 190 were to same friend. The sum of 85 and 190 is 275. It is not a small gift. It is not a small gift. It is not a small gift. Only the small gift is 225. So the 225 thing is the small gift. Done. Now let's start the question over your ACCA platform. I hope this question would be available at ACCA platform. So, sorry. You guys would be opening with me. I am here already. So I'm going on practice test 1. Perfect. So I'm here at the exam question. So are you guys here with me over the so are you guys here? Should I start it? Okay, I'm starting this question. So the idea of doing one question at least on the platform is to more familiarize you guys with this platform and the use of this platform. Adana died on 17th March 2017. 17th March 2020. And IHT of 566,000 is payable in respect of chargeable estate. Under the terms of her will, Adana left the entire estate to her children. At the date of her death, Adana had the following debts and liabilities: an outstanding interest-only mortgage of 220, income tax of 43,700 payable in respect of the tax year 1920, legal fees of 4,600 incurred by Adana's sister, which Adana had verbally promised to pay. Adana's husband died on 28 May 2006 and only 20% of his inheritance tax nil rate band was used. The nil rate band for the tax year 67 was 285,000. On 22nd April 2007, Adana had made a chargeable lifetime transfer of shares valued at 500,000 to a trust. Adana paid the lifetime IHT of 52250 from this gift. If Adana had not made this transfer, if Adana has not made this gift, her chargeable estate at the time of her death would have been 650,000, higher than it otherwise was. This was because of the subsequent increase in value of gifted shares. What is the maximum nil rate band which will have been available when calculating the IHT of 566,000 payable in respect of Adana chargeable estate? So Adana own nil rate band of 325,000 plus Adana husband unused nil rate band, which would be 325,000 multiplied by 80%. So 80% of 325,000 is 260. 260. So it is 260,000 plus 325,000. Total nil rate band becomes 585,000. So the total nil rate band becomes 585,000. Then the second question, moving. I've seen the complete screen. Okay. What is the amount of deductions which would have been permitted in calculating ADANA chargeable estate for the purpose of IHT? What is the amount of allowable deductions? So allowable deductions is mortgage 220,000 plus 43,700. 46 is not allowed because it is a verbal promise. So this amount, the sum of this amount, 263,700 263,700. One by one, if I start looking one by one. Why you take 325? 325 in the previous question. So the scratch pad is open. I take the benefit of a scratch pad. Are you asking about why I take the 325 over here? The answer to this 325,000 is, please focus on my word and be very clear. The unused percentage of nil rate band is transferred, not the amount is transferred. Mark my words. The unused percentage of nil rate band is transferred, not the amount. So in the previous question, by chance, the nil rate band of the death of Lulu and Lebna were same. So that's why that was not an issue. But here the nil rate band is changed. So at the time of that, the nil rate band is 285. And that's why the percentage is given that 20% is used or 20% is unused. So if I repeat my key statement regarding these questions, so unused percentage of nil rate band is transferred, not the amount. Okay, so it's 263. That lower of thing is for the RNRB, and again there is already IHT calculated in the question. Already IHT calculated. Then moving to the third question. Indicate by clicking on the relevant boxes in the table who will be responsible for paying the IHT of 566,000 in respect of ADANA chargeable estate, and what is the due date for payment of this liability? What is the death date of ADANA? It would be 17th March 2020. I would really appreciate if the guys who were taking me the clarification of the timeline to pay the tax, they step forward and answer this. Yes, that would be 30th September 2020. And who would be responsible? Beneficiaries or personal representative. Keep remember, the tax payment responsibility to HMRC lies with the personal representative. Okay, moving ahead. I have seen the complete screen. Okay. How much of IHT payable in respect of Adana estate would have been saved if under the terms of her will, Adana had made specific gifts of 400,000 to her trust and 200,000 to her grandchildren instead of leaving her entire estate to children? Can any one of you tell me the answer of this question? How much IHT payable in respect of Adana estate would have been saved if, under the terms of will, Adana had made specific gifts of 400,000 to her trust and 200,000 to grandchildren instead of leaving her entire estate to her grandchildren? Okay, I'm just taking two more answers. So yes, like I all get, Alhamdulillah, the correct answers. Yes, the correct answer is there will be no tax saving because, like I said, it is sort of skipping the generation kind of thing. Rather than transferring the assets to children, you are transferring the assets to here and there. So wherever you transfer the assets, IHT at the time of estate would remain the same. There will be no change. All of you okay with this 0C answer? I'm just taking further clarification because obviously I don't have the 100% answer. Again, is it transfer in relation to giving to trust? Is it transfer in life or transfer on death? It is transfer on death, right? Like Adana is transferring the asset on death to a trust. So the transfer is on death. So wherever asset is transferred on death, IHT would be 40%. Whether transferred to person, except of one person, which is spouse. If transferred to spouse, then yes, there will be tax saving. Other than spouse, all would be same. The last part of this requirement. How much IHT Adana saved by making the chargeable lifetime transfer of 500,000 to a trust on 22nd April 2007? So it's around 13 years from today. I'm considering this date as today. Rather than retaining the gifted investments until her death, rather than retaining the gifted investments until her death. So, uh, since she transferred the estate to, she transferred 500,000 worth of assets to a trust. There was an IHT of 52250, which she paid on this gift, right? If she had not made the transfer of asset, this asset would have been included in her estate of amount 650,000. Think this thing in the way. If the asset is included in your estate of having amount of 650,000, you have to pay the tax at 40% over this. So 650 into 40% is 260. Then you need to pay 260,000 of tax. And currently you have paid a tax of only 52250. It means you have saved the tax of minus 52.25, 207,750. That is, what is your amount of tax saved? That is 207,750. Is this thing clear? Is this thing clear? Okay. I'm done with the inheritance tax thing. Now I'm moving towards the second agenda of today, which is value added tax. Value added tax. Value added tax for VAT purposes, two concepts to remember. One is called output tax, which is charged on sales. Second one is called input tax, which is incurred on purchases and expenses. For VAT purpose, type of supply. Type of supply can be categorized into two categories. One is called exempt supply. Second one is called taxable supply. For exempt supply, no tax charge. Trader is unable to register, unable to reclaim input VAT. So, for such persons, VAT is an expense. Whereas a second category is taxable person. Taxable supply can be categorized into two categories: zero rated, standard rated. Zero rated means you have to charge VAT at 0% at the time of sale, and standard rate means you have to charge VAT at the rate 20% at the time of sale. Keep remember, both are under the scope of taxable supplies. Trader is able to register for VAT, and trader can reclaim input VAT. For such persons, keep remember, VAT is not expense. If VAT is not expense, such persons would record in P&L the goods and purchases by net amount, and such persons would record sales purchases in P&L by gross amount. VAT registration. VAT registration can be done into two ways. One is called compulsory registration. Second one is called voluntary registration. Compulsory registration is required when value of taxable supplies exceeds the registration threshold of 85,000. Taxable supplies include zero rated and standard rated, but not exempt supply. Keep remember, mark my word, exempt supply is not part of taxable supply. Two things are part of taxable supplies. One is zero rated supplies and another one is standard rated supplies. Voluntary registration. When trader making taxable supplies can register anytime, allows recovery of input VAT, allows recovery of input tax. What are the advantages? You can recover your input tax if making zero rated supplies. VAT return will show VAT repayable. You can register for monthly return to aid cash flow. avoid penalties for late registration, may give the impression of more sustainable business. So 1, 2, 3, 4 advantages. Disadvantages. Output VAT needs to be charged on sales. If making standard rated supplies to customers who are not VAT registered, will be an additional cost to them. Like if I talk about myself, if I talk about consumer. So if you are a shopkeeper, you are selling goods to a general public, you are not VAT registered, you will not charging the VAT. But if you register for VAT, you have to charge 20% additional to customer. From a customer perspective, it is an additional cost. This thing may affect your competitiveness as well. And secondly, you need to administer the VAT as well. So you have to bear the administration cost and time. Deregistration. You want to leave the universe of VAT. Deregistration. Before I start deregistration, keep remember one thing. VAT is an indirect tax which is levied upon consumption of goods or services. Deregistration. Compulsory deregistration, voluntary deregistration. Compulsory deregistration. When cease to make taxable supplies, when you cease to make taxable supplies, you have to inform HMRC within 30 days of ceasing to make taxable supplies. You will be deregistered from date of cessation or any earlier agreed date. When you cease to make taxable supplies or cease your business, both things are same from the VAT perspective. Voluntary deregistration, when expected value of taxable supplies in next 12 months to be less than 83,000 next 12 months. Okay. Inform HMRC at any time. You will be deregistered from date of request or any earlier agreed date. VAT inclusive rates. VAT is equal to gross amount into 20 over 120. Important theory starts. Tax point. The basic tax point. The basic tax point for goods services. For goods, the basic tax point, the goods when they are available to customer. For services when they are completed. The basic tax point is changed to earlier date if payment is made or invoice is issued before basic tax point, then this date becomes actual tax point. If invoice is issued later date, if invoice is issued within 14 days after the basic tax point, then this date becomes the tax point. Tax point is the point basically on which time, on which moment the VAT on the transaction is due is called as tax point. I repeat, the tax point is basically the point, the moment at which the VAT on transaction is due is called as the tax point. So tax point can be in relation to goods or services, by the way. One transaction can have more than one tax points. Mark my words, keep remember. One transaction can have more than one tax points. How, sir? How it is possible? More than one tax point, take it in this way. For example, there is a contract over which I demanded the 50% payment before completion of work and 50% payment would be after completion of work. So completion of work means goods available to customer when goods are available. So for half of the transaction, the tax point would be like when I'm receiving the cash, and for half of the transaction, when the goods are available, or when the invoice is issued, or whenever the cash is received. But for half of the transaction, for half of the amount, the tax point is when the cash is received. Uh, then we have the output VAT and input VAT. There are several important points regarding output VAT and input VAT that should be remembered. What are the important points? For VAT purpose, there is no distinction between revenue and capital items as there is for income tax and corporation tax. Like in income tax and corporation tax, we make the differentiation between capital expenditure and revenue expenditure. We would not be making any such differentiation in the VAT universe. So for VAT purpose, over the sale of capital expenditure or revenue expenditure, over both the things, we would be charging the output VAT, and over the purchase of revenue item or capital item, we would be claiming the input VAT. So for VAT purpose, there is no distinction between revenue and capital items. Output VAT is charged on the actual amount received if discount is offered for a prompt payment. So if there is an early payment discount, so VAT would be calculated on the after discount amount. Relief for an impairment loss. The impairment loss here means the bad debt. The relief for impairment loss is only available if the claim is made more than 6 months from the time that payment was due and the debt has been written off in the business books. So two conditions. Let me mark two conditions separately. First condition, if the claim is made more than 6 months from the time that payment was due, like the debt should be more than 6 months old and the debt has been written off in business books. The debt has been written off in business book. So two conditions. It should have to be written off. Second, it should have to be more than 6 months old. Then input VAT cannot be recovered in respect of business entertainment or the purchase of motor car, except of non-UK customers. So if business entertainment relates to non-UK customers, then it can be recovered. And if the car is used 100% for business purpose, then it can be recovered. Otherwise, it cannot be recovered. Keep remember two further things. One further thing. This is the only place where we have to take care of business private use of employees as well. Otherwise, from trading income perspective and all of the tax purposes, for employee, we do not make any differentiation between business private use of employee. But this is the only instance where we would be considering the business private use distinction of employee as well. Then, input VAT cannot be claimed in respect of goods or services that are not used for business purpose. An apportionment is made where goods or services are used partly for business purpose and partly for private purpose. Supply of sample to customer was not treated as supply of goods. Okay, so if you are supplying a sample to customer, it is not treated as supply of goods. Goods supplied free of charge. So if there is offer like buy one get one free type of things or buy two get one free kind of thing, so it is goods supplied free of charge. When goods are supplied free of charge, then output VAT must normally be accounted for. However, there is generally no output VAT on services supplied free of charge, regardless of whether they are supplied to an employee or to a customer. So if there is a goods supplied free of charge, if there is buy one get one free, buy two get one free, so over get one free, there is an output VAT as well. However, if there are free of cost services, so free of cost services, there will be no output VAT. There is now no limit to the number of business samples that can be given to same customer. Previously, the first sample to each customer was not treated as supply of goods subject to output VAT. So previously there was a limit of only one sample, but now there is no limit of sample. So make proper differentiation between the sample and a free of cost goods or service. Motor expenses. Input VAT can be recovered where fuel is used for private mileage, either by a sole trader or an employee. But output VAT must then be accounted for. Output VAT must then be accounted for. So output VAT is normally calculated according to a scale charge, which is normally inclusive of VAT based on car engine size. The scale charge will be provided in the exam. A business has the following options when providing fuel for private mileage. Claim all of the input VAT with output VAT calculated according to a scale charge. Option 2. Charge the employee for the full cost of fuel provided, like whatever is the amount of private fuel, charge it to employee. All of the input VAT can then be claimed with output VAT calculated on the charge to employee. So which method to use, that would be specified directly or indirectly in the paper. So in relation to fuel, you have two options. First, okay, for both the options, I highlighted two things, and I am highlighting it by the use of highlighter. Claim all of the input VAT. All of the input VAT can then be claimed. So in both the options, if you read it carefully, all of the input VAT can be claimed. Just the difference is to calculate the way of output VAT. Under first option, output VAT is calculated according to scale charge. And about scale charge, I mentioned that it is based on car engine size, and that would be provided in the exam. And under this situation, under the second situation, output VAT calculated on the charge to employee. So whatever you are charging to the employee for private use of the fuel, output VAT would be calculated based on that principle. Provided there is some business use, input VAT can be fully recovered in respect of repairs to motor car. No apportionment is necessary. So provided there is some business use, input VAT can be fully recovered in respect of repairs to motor car. No apportionment is necessary. No need to make the apportionment. Where a leased motor car is only available for business use, complete lease rental is allowed expense. So if complete business use, complete allowed expense. If leased motor car is available for private use, 50% of input VAT on leasing cost is non-deductible. 50% of input VAT on leasing cost is non-deductible. Or you can say 50% is non-deductible or 50% is allowed. Both are the same things. So I'm taking 30 seconds pause. Any questions till now from the VAT thing? Yes, the reason is because there are so many tiny things in the VAT to cover, like in inheritance, there were not so many tiny things to address. Like there are the broad things to address but needs practice. But from the VAT perspective, there are tiny things to address, and they are not as such technical. So these are more of a rule-based things, whereas IST is more of a understanding-based or logical-based things. Okay. If there is a lease of motor car, so three possibilities. Let me make a simple table in front of you. For lease of motor car, three possibilities. 100% business use, 100% private use, partial business use, or you can say partial private use. If 100% business use, 100% lease cost is allowed. If 100% private use, 0% lease cost is allowed. If partial business use or partial private use, whatever you want to say, 50% of lease is allowed. So it's not like that the business uses 25%. So what percentage of lease would be allowed? It would be 50%. So the most important thing is to remember this area. If partial business use, this partial can be any percentage. This partial can be any percentage. No, output VAT is either calculated on charge to employee or output VAT is calculated on the scale charge. Output VAT is not on complete basis. And so moving ahead. Pre-registration input VAT. Pre-registration input VAT is, can we recover the input VAT which I paid before the registration? Can I recover the input VAT which I paid before the registration? The answer is yes, for goods and services. For goods which are acquired in the 4 years before registration, can be recovered, but with a condition. It's still held at the date of registration. It's still held at the date of registration. Whereas for services, services supplied in the 6 months before registration can be recovered. Services supplied in the 6 months before registration can be recovered. Then these are the important things. Schemes for small businesses, and all of these schemes are optional, not mandatory, optional. First scheme is called as cash accounting scheme. Under the cash accounting scheme, I have to account for VAT on cash receipts or payment basis. The advantage is automatic relief for impaired debts. You can join this scheme if your turnover is less than 1.35 million and VAT is up to date. Must leave if taxable turnover exceeds 1.6 million, excluding VAT. So under cash accounting scheme, you have to account for VAT on cash basis. You receive the cash, output VAT. You paid the cash, input VAT. Second thing. Keep remember one further thing regarding these small schemes. These schemes are applicable for trader to HMRC. These are not applicable on trader to customer. Like for trader to customer, normal rules will apply. However, these accounting schemes are for trader to HMRC, like how much VAT to pay to HMRC, how much VAT to receive from HMRC. These schemes are applicable on these situations. These schemes are not applicable to the that thing, to business to customer. It is on business to HMRC. Annual accounting scheme. Okay, before I start the annual accounting scheme, keep two things remember. One, VAT, how to calculate VAT? Output minus input, the difference is your net VAT payable. Repeat. How to calculate VAT? Output minus input, the difference is net VAT payable. Second, VAT is calculated by default, not in cash accounting scheme by default. VAT is calculated on accrual basis, not on receipt basis. VAT is calculated on accrual basis. Third thing, what is the timeline to pay the VAT? What is the timeline to pay the VAT? The timeline to pay the VAT is 1 month and 7 days from the end of quarter. What is the timeline to pay that to pay the VAT? The normal timeline is 1 month and 7 days from end of quarter. So this is the normal timeline to pay the VAT. Under cash accounting scheme, so three fundamentals which I just explained. First, output less input is the net payable or receivable. Is the net positive or negative? Second, VAT is on accrual basis. And third, this one. Under this scheme, one same, two same. Only this philosophy changed. That VAT would not be on accrual basis, it would be on cash basis. For this thing, this principle is changed. Whereas for the annual accounting scheme, as the name refers, annual accounting scheme, it means this same, this would be changed. Like VAT would not be submitted quarterly. Here the VAT would be submitted on annual basis. Here the VAT would be submitted on annual basis. Now let's look into the details of this. Annual accounting scheme. One VAT return per annum would be submitted, and it should be submitted within 2 months after year end. So take it in this way. If my VAT year is from, make it 1st January to 31st December. 1st January to 31st December 2019 is my VAT year. So when should the VAT return be submitted? It should be submitted within 2 months after year end. So year ends on 31st December, 2 months 28 Feb. So it should be submitted within 28 Feb 2020. Payment on account in month 4 to 12. Payment on account means you have to pay installments 4 to 12. If you count month 4 to month 12, means there will be 9 payment on account. There will be 9 payment on account, and balance with return. Return means you can join if turnover is less than 1.35 million and VAT up to date. Must leave if taxable turnover exceeds 1.6 million excluding VAT. One thing I like to add over here in the annual accounting scheme, POA is based on VAT liability of previous year. So POA would be based on VAT liability of previous year. So to explain you guys over this thing, and my assumption, my year was 1st January 2019 to 31st December 2019. I have to pay VAT in installments from month 4 to month 12. Like I have to pay installments in April 19, May, June, July, August, September, October, November, December 19. So this becomes 9 installments. 10th, the balance with return. So balance would be with return. Return means within 2 months after year end. Installments would be based on VAT liability of previous year. So whatever is the liability of 2018, divide the liability of 2018 by 10. I repeat, divide the liability of 2018, the previous year liability, by 10. Make 9 monthly installment from 4 to 12 months, 9 installment, and 10th installment as a balancing payment. Flat rate scheme, the sweetest and simplest. Under the flat rate scheme, keep remember one thing. Let me use this color. Under the flat rate scheme, This principle is same. This principle is same. Only this principle is changed. Under the flat rate scheme, what is the flat rate scheme? Under the flat rate scheme, you can join if taxable turnover for next 12 months is less than 150,000 excluding VAT, and you have to leave if taxable turnover exceeds 230,000 including VAT. Please from MCQ perspective, do good take care of this, where excluding and where including. In this situation, under the flat rate scheme, you pay VAT as percentage of VAT inclusive turnover. So, which is based on industry. So, here under the flat rate scheme, the VAT payable is gross turnover, VAT inclusive turnover multiplied by flat rate percentage. The turnover is so let me zoom it out. I'm done with the discussion of pre-registration and these optional schemes. Happy to take your questions now. Is it any quarter end or according to company account? The quarter end runs basically from the time when you are registered from VAT. So if you are registered on, let's say, January, so your quarters would be Jan, April, July, October. It has nothing to do with your company's year end or half year end. Gross turnover means including VAT. So one thing is called net amount, gross amount. Gross amount is the one which is including VAT. So gross turnover means inclusive of VAT turnover. I hope it clarifies. Then the concept of VAT groups. VAT group, to create a VAT group, there should be common control. Control means shareholding should be 50% above. If a VAT group is established, what will be its consequence? One VAT return would be submitted for whole of the group. Representative member would be responsible to submit the VAT in the group. All members are liable. So if any error or mistake in the VAT return, all members would be equally liable for the error. No VAT on supplies between group members. So within the group, intra-group sales, there will be no VAT payable. What are the advantages of VAT group? Just a theoretical discussion. So listen to the discussion carefully. What are the advantages of VAT group? First advantage, there is no need to charge VAT on intra-group sales. Okay, so possibly cost saving, hassle free, less administration required. Biggest advantage. Second advantage, there might be possible cost saving. Cost saving in the sense, like previously, if we have three companies, for three separate companies, we need three separate VAT accountants. But if now there is a there is a group VAT registration, so probably we only need now one VAT accountant who can take care of all of the VAT affairs of three companies. So saving in cost. On the other way around, there are disadvantages as well. What are the disadvantages of VAT group registration? First disadvantage, if there is an error, so all of the companies would be equally liable in front of HMRC. Internally, what we do with the error making company, that's a different story. But in front of HMRC, all of the companies are now blacklisted. So all companies are equally responsible in front of HMRC. The second disadvantage about it, like possible conflict management. Maybe take it in this way. I am a company who likes the annual accounting scheme. Now, and you are the company who likes the cash accounting scheme. There is a third company in the group who likes the flat rate scheme. So after this thing, can we fulfill the wish of all of the companies? The answer is no, because all of the group is considered as single entity for VAT purposes. That's why you are submitting one VAT return. One more point I like to add. Cherry picking is allowed. Cherry picking means it is not necessary to include all group companies in the VAT group. So you can, assumingly there is parent and there are three subsidiaries, subsidiary 1, subsidiary 2, subsidiary 3. So is it necessary to include all of the subsidiaries in the VAT group? The answer is no. You can exclude any of the subsidiary company you want. Sale of a business as a going concern. Sale of a business as a going concern means you are disposing of your ongoing business. First, a sale of business as a going concern is outside the scope of VAT, and therefore output VAT is not due. Output VAT is not due on the sale of a going concern business. However, if purchaser is already registered for VAT, then business VAT registration will be cancelled. If the purchaser is not registered for VAT, then it can overtake business VAT registration, although from a commercial point of view, this may be inadvisable. Then, few of the general theoretical points. VAT invoice. What are the contents of VAT invoice? Supplier name, address, VAT registration number, text point, invoice date number, description of goods, quantity of goods, type of services, rate of VAT, VAT exclusive amount of each supply, total amount of VAT before discounts, amount of VAT chargeable, rate of any cash or settlement discounts offered. Then the second discussion is about the administration of VAT. On registration, the trader must charge VAT on his or her taxable supplies. Trader can also reclaim input VAT on all taxable supplies purchased. At the end of a 3-month period, the trader account to HMRC for all of the output tax less input tax on form VAT 100, which is called as VAT return. So I come to know one thing, that VAT is returned on a form. The name of the document is VAT 100. The VAT return together with any payment must be submitted electronically. The VAT return together with any payment must be submitted electronic. It's not your discretion. It must be submitted electronically. The deadline for doing this is extended by 7 days. For example, in the quarter ended 31st March 11, a business will have until 7th May 11 to file an online VAT return and pay any VAT that is due. So essentially, the payment and return submission is same time, no time gap between return submission and payment, and the timeline is 1 month and 7 days. And the timeline is 1 month and 7 days. A trader must keep records sufficient to allow for completion of the VAT return for at least 6 years. So till what time records must be retained? Records must be retained till 6 years. So taking the questions, then we'll move ahead. Flat rate is payable again 1 month and 7 days. It is 7th May, it is 1 month and 7 days. So if the quarter end date is 31st March, 1 month would be 30th April, and 7 days. No need to look in the fiscal year for VAT. No need to look for fiscal year. Yes, flat rate scheme. In flat rate scheme, output VAT is charged on all sales. Zero rated, standard rated, exempt. Uh, for VAT group, the key points are mentioned, plus I explained the advantages and disadvantages. So if any point is unclear, I can tell you. It is 1 month and 7 days. Again, like I said, over the flat rate scheme, this is same. So 1 month and 7 days from end of quarter. So it is quarterly, 1 month and 7 days. Continue with the discussion. Errors. If there are errors in VAT return, two possibilities. Either it could be disclosed by taxpayer or it could be discovered by HMRC. If discovered by HMRC, default interest will be due. Default interest will be due. If there is a serious misdeclaration, there will be penalty, which depends upon behavior of taxpayer. Genuine mistake, no penalty. Careless error, 30%. Deliberate, 70. Concealment, 100. If disclosed by taxpayer, then you have to look whether the error is small or large. If error is small, then correct the mistake on the next VAT return. If the error is large, inform, notify HMRC and provide the explanation of how the error occurred. Consequences, pay HMRC the VAT owed. So whatever is the underpaid tax paid, default interest will be due. So default interest will be due. What is the definition of small error? So what is a small error? What is large error? A small error is greater of 10,000 or 1% of turnover with upper limit of 50,000. So any error which is in this limit is called as a small error, and if the error is a small error, you can correct it in your next VAT return. After the error, default surcharge for late payment. So what will be the default surcharge for late payment? Keep remember, there is a complete process for late payment process. The late payment process is, if you late first time ever in your life, there will be no penalty. Rather, there will be a surcharge period or notice period will be issued. The time duration of this notice period is 12 months. So at this point of time, no penalty, only a notice period. Notice period is a sort of warning that, look, you are late first time. Right now, we are not charging you any of the penalty. If you again late, we will charge you penalty. A warning. If within and the duration of notice period is 12 months. After the issuance of notice period, if you again get late within that 12 months, then that would be considered as your first default. And over the first default, penalty is 2%. And your notice period extends to the next 12 months from the late date. Make it in this way. I late first time in ever on 31st December 2018. 31st December 18. Please listen to the story carefully. 31st December 18, I late first time. 31st December 18 to 31st December 19 would be my notice period, the surcharge period. I late on 30th September 19. This would be my first late within the notice period. My current notice period would extend to 30th September 20 and my penalty percentage would be 2%. If I late again on 31st March 2020, that would be considered as my second late. My penalty would be 5% and my notice period extends to 31st March 2021. means notice period keep extending from 12 months from your date of late, and your penalty percentage keep increasing. A possible question, sir, if once the notice period, if once the surcharge period is issued, how to get rid of, how to overcome it? The way out to overcome this surcharge period is submit 4 continuous returns on time. Submit 4 continuous returns on time. So if you do not submit 4 continuous returns on time, if you submit 3 returns on time, 4th went late, then again your notice period would be extended. So if you once submit 4 continuous returns on time, your existing notice period would be finished, would be completed. Then if you again get late, a new notice period would be issued. Then overseas aspects of VAT for transactions within non-European Union. Transactions outside the European Union, if export 0 rated, services outside the scope of VAT. If importer accounts for VAT as they bring goods into the UK. Hysteric means needs to discuss. Overseas VAT within the European Union. Status of parties. Supplier and customer are VAT registered. If supplier and customer are VAT registered, let me make a more simpler table for you. Overseas VAT within European Union. Sale, purchase, VAT registered, okay. If you are making a VAT registered, if you are making a sale to VAT registered business, that would be 0 rated. If you are making a sale to VAT unregistered business within European Union, that would be standard rated. That would be standard rated. If you purchase the goods from VAT unregistered business within European Union, like I am in UK, I am purchasing goods from a supplier based in France who is VAT unregistered. Technically speaking, if my supplier is VAT unregistered, would he able to charge VAT to me? Would he able to charge VAT to me? The answer is no, correct, because he is not VAT registered. So in this situation, VAT would be not applicable, right? Because the supplier is not VAT registered. Whereas if I purchase from a VAT registered supplier, In this situation, supplier has to pay VAT to HMRC as output VAT. Later, supplier can recover this as input VAT. So, if you are purchasing the goods from outside within the European Union, and you are purchasing the goods from a VAT registered supplier, so like you are charging zero rate, that supplier would also be charging you zero rate. But in this situation, HMRC levies you that you pay 20% the output VAT directly to HMRC. Like if you would have purchased the goods from the UK, you would have paid 20% to HMRC via supplier. So in this situation, pay 20% directly to HMRC, and then as per normal, you can recover this amount as your input VAT as normal. So I'm done with the discussions. For out of UK services purchase, that is the outside of scope of VAT. I repeat the last part. The last part is if you are selling, I'm discussing the overseas aspect of VAT within the European Union. I'm selling goods or services within the European Union. If it is sale to unregistered business, that would be zero rated. If it would be sale to unregistered business, so this is you have to memorize this table, that would be standard rated. If you purchase the goods from unregistered trader, VAT not applicable because charging the VAT is the responsibility of supplier. In this situation, I'm basically saying supplier is unregistered, so he cannot charge the VAT on me. In this situation, a bit detail is required. That's why I am disclosing the detail over here. Supplier has to pay VAT to HMRC as output VAT. So once he receiving the goods, releasing the goods from the port of the country, he has to pay output VAT directly to HMRC. Later on, the supplier can recover this amount as input VAT. Okay. Now I'm moving towards the question part since no question received. So with respect to questions, like two MCQs, then we'll move on to at least one MTQ for today. Why Limited is registered for VAT and use the flat rate scheme? Why Limited is registered for VAT and use the flat rate scheme? In the quarter ended 31st March 20, the company had a VAT inclusive turnover of 110,000. This comprised standard rated sales of 80,000, zero rated sales of 20,000, and exempt sales of 100,000. Exempt sales of 10,000. The flat rate scheme percentage for company trading sector is 9%. So flat rate percentage is defined by HMRC on business to business, industry to industry basis. So it's not like that flat rate percentage is same, is constant for all. It is changing for each and everything. So first thing to check, 80,000, 20,000. Is it VAT included amount or is it VAT exclusive amount? It is total turnover is VAT inclusive. So accordingly, total turnover is done VAT inclusive. Accordingly, this would be inclusive. This would be inclusive. So 110,000 into 9%. That amounts 9,900. So the VAT payable for the quarter ended 31st March 20 is 9,900. Then, second question. Emily is registered for VAT for the quarter ended 31st March 20. The input VAT incurred on his purchase and expenses include the following: entertaining overseas customer, purchase of new office equipment, purchase of new motor car for business and private use by one of Emil's employee. What is the amount of input VAT recoverable by ML in the quarter ended 31st March 20 in respect of entertaining office equipment and motor car? So what is the amount of input VAT? Since it's entertaining overseas customer, it can be recovered. It is purchase of new office equipment. It can be recovered. Since it has some private use, if the car has 100% business use, then I can recover. Otherwise, no, I cannot recover. It is already gross amount. So we have to take the 9% of VAT include gross turnover into flat rate percentage. So if it would be net amount, so I have to convert it gross amount, then apply the percentage. Since it's already gross amount, so directly apply the 9% thing. How they are share? What is share? How? Although one thing, like here it is not clearly mentioned whether the amounts are VAT inclusive or exclusive. Keep remember from the question perspective, from the exam perspective. If it is not mentioned whether the amount is inclusive or exclusive, you always assume that amounts are exclusive of VAT. So 320 plus 1250 into 20%. That's 1570 into 20% is okay, perfect. So thank you. It's the VAT amount. It's not the like I am not supposed to take the 20%. It's already VAT amount. So again, like we discussing yesterday, read the question carefully. So read the question carefully. The input VAT incurred. So it's already the VAT amount. Since it's already VAT amount, so just need to sum up these two things. That is 1570. Okay. I have time to go with one question only. So just taking an idea. So should I go for the CP ACCA platform question, or should I go to the manual handwritten question? First, I would be deciding based on the first 5 comments. So out of the starting 5 comments, only one is for manual and 4 is for ACCA platform. In fact, so based on the first 5 comments, I'm going for the ACCA platform question. So let me tell you one thing. If you look into this one handout, so there are 2 questions relating to VAT. One is we are done with the Diana question based on the ACCA platform. One is THEDAR and one is Glacier Limited. So Glacier Limited is available in the ACCA platform. THEDAR is not. I would be sharing with you guys the proper video solution of THEDAR and the video solution of the yesterday question. So right now I'm going to the Glacier Limited question. Okay, so Glacier Limited. So for Glacier Limited, I'm opening up my test reach. By the way, WhatsApp link. I don't have the WhatsApp link available with me. So I am sharing my WhatsApp number with you guys. You drop me a text over you drop me a WhatsApp. I will add you people over the WhatsApp. Okay. So I hope all of you can see it. Okay. I'm going to the specimen paper. I'm going to the specimen paper. I'm going to the specimen paper. And my paper is started, and I'm going for the VAT question directly. So if I look where the VAT question, the answer is no. The answer is no. Okay. The following information is available in respect of Glacier Limited VAT for the quarter ended 31st March 2020. So the following information is available. Like before I start the question, let me mark one thing just for my own purposes, for my own reference. We are done with this question on ACCA platform, and we are done with this question on ACCA platform. So One question is left from today and one question is from yesterday. The following information is available in respect of Glacier Limited VAT for the quarter ended 31st March 2020. Invoices were issued for sales of 44,600 to VAT registered customers. Of this figure, 32,500 was in respect of exempt sales and the balance in respect of standard rated sales. The standard rated sales figure is exclusive of VAT. Okay. In addition to the above, on 1st March 20, Glacier Limited issued a VAT invoice for 8,000 plus VAT of 1,600 to a VAT registered customer in respect of a contract that will be completed on 15th April 2020. The customer paid for the contract in 2 installments of 4,800 on 31st March 20 and 30th April 20. Please, guys, listen to my discussion very carefully. For such questions, one of the important thing is how to calculate like what is the tax point of such transactions. If I look into the second transaction, what is the time the goods will be available to customer? Like a contract is a goods or service, whatever. When it will be completed on 15th April 2020. So the basic tax point is 15th April 2020. Then, is the invoice issued before the basic tax point? What is the date the invoice is issued or the cash is received? The invoice, in addition to the above, on 1st March 20, Glacier Limited issued a VAT invoice. So the invoice is issued. Since the invoice is issued, the tax point is established. The tax point is established. So it means for this transaction, the tax point is 1st May 2020, because on this date issued an invoice for 8,000 plus VAT of 1,600. Then the managing director of Glacier Limited is provided with free fuel for private mileage driven in her company motor car. During the quarter ended 31st March 20, total cost of fuel for business and private mileage was 720, of which 270 was for private mileage. The relevant quarterly scale charges 414. All of the figures are inclusive of VAT. For the quarter ended 30th September 18 and 30th June 19, Glacier Limited was 1 month late in submitting its VAT return and paying in the related VAT liabilities. All of the company other VAT returns have been submitted on time. What is the amount of output VAT payable by Glacier Limited in respect of its sales for the quarter ended 31st March 2020? In respect of sales. So if I talk about sales thing, sales to customers, 44,600 minus 35,200 into 20%, because exclusive of VAT. So the answer to this thing is plus. Tell me one thing. In relation to the contract, is the tax point established in the quarter ended 31st March 20? The answer is yes, the tax point is 1st March 20. So I have to account for the VAT of contract. The tax point is tax point. So this amount 1,600, and by the way, this amount this amount. $1,880. So if there will be zero rated sales, then it would be, if it would be zero rated sales, then there will be zero output VAT. 144 I missed the figure. Can anyone repost the answer, please? 1,880. Okay. 1,880 plus 1,600. Total output VAT is, thank you, 3,480. So 3,480. Done. Moving ahead. I have read all of the questions. Okay. Calculate the amounts required to complete the following sentence in whole pound. So do not input the decimals. Glacier Limited will include output VAT of dash and input VAT of dash on its VAT return for the quarter ended 31st March 20 in respect of managing director motor car. In respect of managing director motor car. For this part of the question, let me put output VAT. Tell me just one thing. Is it mentioned that what is the amount charged to director for private use of fuel? Is it mentioned? All amounts are inclusive of VAT. Is it mentioned that what is the amount charged to director for private fuel? Read the third point. It's in front of you. Correct. It is not mentioned. So since it is not mentioned, so you cannot go for charge to employee option. On a no choice basis, you have to stick on the output VAT based on CO2 emission, based on the scale charge thing. Okay. Total cost of fuel 720 divided by 120 multiplied by 20. So this amount this is 120, correct. 414 divided by 120 multiplied by 20. 69. So output VAT of 69, input VAT of 120. Because the amounts in the point number 3 are inclusive of VAT. And what about private use? So remember, I highlighted all of the input VAT can then be claimed. So all of the input VAT would be claimed. That's why no distinction kind of thing. That's why not considering the private use. Then what surcharge penalty could Glacier Limited be charged if company is 1 month late in paying its VAT liability for the quarter ended 31st March 2020? Yes, here is private use. Can you guys please look into the question? In the meanwhile, I'm addressing one query. Yes, there is some private use. So when there is a private use for fuel, output VAT is calculated on the scale charge or it is calculated on the charge to employee. All of the input VAT in both the options is claimable. So if you look into the notes again, so all of the input VAT is claimed with output VAT is on scale charge or output VAT is on the basis of charge to employee. Okay, for this part, for the quarter ended 30th September 18 and 30th June 19, Glacier Limited was 1 month late in submitting its VAT return and paying the related VAT liability. So 4%. Okay. All of the company other VAT returns have been submitted on time. So first late is 30th September 18. From 30th September 18, you will be available time till 30th September 19. But you were late before 30th September 19. So this would be considered as your first late over which your 2% penalty would be applicable. After this late, your notice period would have extended till 30th June 2020. So before 30th June 2020, you were again late. Since you are again late, so that would be considered as your second late, and second late means your penalty would be 5%. Your first late is 30th September 2018. Over this date, your notice period would be issued, which will end up on 30th September 2019, the 12-month period. Then it was your notice period in the process. Within the notice period, you are late. Submit on 30th June 2019. Means this is your first late and notice period extends till 30th June 2020. Then within the notice period, like it's the single notice period which is continuously extending. Within the notice period, you are again late. Submit on 31st March 2020. That would be considered as your second late, and your notice period extends till 31st March 2021. I hope it would be clear now. Moving ahead. What is the minimum requirement which Glacier Limited needs to meet in order to revert a clean default surcharge record? So if a clean default surcharge record, submit 4 consecutive VAT returns on time, submit any 4 returns on time and also pay the related VAT liabilities on time, pay for consecutive VAT liabilities on time, submit 4 consecutive VAT returns on time and also pay the related VAT liabilities on time. So 1, 2, 3, 4. Which option is correct? The option D is correct because only submitting the return is not an option. Remember, you have to submit the return and must pay along with the VAT liability. So submit 4 consecutive returns on time and pay the VAT liability. Last part. Glacier Limited will be required to issue a VAT invoice in certain circumstances. Complete the following sentence by matching one of the type of supply and one of type of customer into each target area. Glacier Limited required to issue a VAT invoice when dash is made to dash, when type of supply and type of customer, when a standard rated supply or any type of supply, when a standard rated supply, correct, is made to a VAT registered customer or to any customer. Keep remember. We are talking about the requirement clearly asked required. Required means mandatory. Mandatory means if you do not do this, there will be legal implications for you to do this. So if you are like if you don't have a VAT registered customer, then it's fine not to give him a VAT invoice. It's fine. Like it's good to have, not mandatory. But if there is a VAT registered customer, then it's mandatory to give the VAT invoice, because if you give him the VAT invoice, then he will be able to recover his own input VAT. Like he needs the documentary evidence that you need the charge, you charged VAT on him. Okay. Okay, guys. So I hope so. The circumstances in which not okay, you can let me know. I try to resolve. I try to increase the level of this okay. So I hope that would be a good refresher, a good practice with you guys. Well, from this statement, doctor, you just reminded me that I'm supposed to share something with you guys. So would share with you by today before I sleep in next couple of minutes, and probably 1 hour, 2 hour, maybe. So see you guys tomorrow. One thing I like to advise you guys, please try to read the notes for tomorrow before tomorrow's session. So to have more understanding, to have more good discussion, to have more your questions answered. Okay. So see you guys tomorrow, inshallah. Thank you very much. Take care. Allah Hafiz. Good night. Bye bye.